Relative value investing can be smart, but it can also be complicated and downright exhausting. Unless you invest using Direxion's revolutionary relative weight ETFs. They're a smart, simple, cost-effective way to make a relative value investment only from Direxion. Introducing Direxion's all-new relative weight ETFs. Act on your convictions with just a click. Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus. Available at DirexionInvestments.com. Read it carefully.
Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card, and author, Ron DeLegge.
Coming up on today's program, we're going to talk about the superiority of the ETF product structure and how that benefits you, the investor. Also coming up, we're going to get into some of your tweets as well as your calls if you'd like to join us. 844-305-7800 is the number. Give us your first name along with your city, as well as any ticker symbols of stocks, mutual funds, or ETFs you'd like to discuss. We can also talk about investment strategies. How are you doing so far in 2019? First month of the year is already over. 844-305-7800. So let's take a quick gander and see what happened this past week in financial markets. The S&P 500 edging up about 0.5% this past week, led by utilities, which advanced almost 2% on the week. And we had also the technology sector delivering a 1.8% gain. So those were the two leading industry sectors. Meanwhile, the energy sector, which has been a star performer over the past month, fell by just a little over 3%. We'll get you caught up, though, on what the year-to-date bigger picture view of these various sectors is. We, of course, don't want you to have a micro or narrow view by just looking at the weekly performance. Now, in terms of corporate earnings, we've got 66% of companies in the S&P 500 already have reported fourth quarter earnings. So the question then becomes, well, has it been good or has it been bad? Well, so far, we've got most companies exceeding analyst estimates. We've got, for example, according to FactSet, in revenue terms, the percentage of companies reporting actual revenues above estimates, 62%. So 62% of those companies reporting have actually beat revenue estimates. So that's good. That's good. Now, certain sectors are doing better than the others in terms of year-over-year growth. Energy, communication services, and industrials, those are the top three in terms of year-over-year growth for 2018. And those ticker symbols, XLE for energy, communication services, XLC, and then industrials, XLI. We'll get you caught up a little bit later on what the performance figures are for the leading industry sector ETFs and get you caught up on that. Now, for today's conversation, I want to focus on the superiority of the ETF structure. ETF, of course, is an acronym for Exchange Traded Fund. And we talked about this a little bit on last week's program, at least we led into it, explaining why exchange traded funds are superior investment vehicles, especially when compared to mutual funds. So we're going to discuss this on today's program. There's been, over the years, a lot of debate about whether ETFs will overtake mutual funds in terms of popularity, and I think they have. The one thing that mutual funds still have up on ETFs, of course, is their foothold in the retirement plan market, specifically 401k plans, 403bs, 457 plans, and the like. Mutual funds continue to dominate. And if it wasn't for retirement plans, ETFs would have long surpassed mutual funds in terms of overall popularity and assets. But we're going to take a look at this from kind of a different angle. And this is actually on our Twitter feed at Index Show, a link to an article by Barron's. And the title of the article is Why ETFs Will Shine This Tax Season. And they really are focused on how mutual funds pay out capital gains that investors owe tax on. And this year, the bill is a whopper. That's according to Barron's. Large cap equity funds, for example, lost an average 6.3% last year. But to add insult to injury, they distributed capital gains to fund shareholders that amounted on average of almost 11% of the net asset value, according to Morningstar. Now, investors who hold these funds in a taxable account must now pay tax on these phantom profits. So let's just think about this for a second. You own a large cap stock fund in a taxable account, and on average, that fund lost just over 6% in value. Yet, these funds, on average, still distributed a capital gain that amounted to almost 11% of the NAV. So how does that make sense? Well, the way that the mutual fund structure is built is that those capital gains are realized by the fund and then passed on to you, the shareholder. ETFs that invest in equities, meanwhile, lost money in 2018. If we just look at large cap equity funds or ETFs, they lost money. But the difference is that they hardly distributed any capital gains. In fact, pennies for most funds, if any, if there were any distributions at all. And so what we mean for you as an investor, what the translation is, if you own any kind of mutual fund in a taxable type of brokerage account, whether that's an individual account or a joint account, and you're getting a 1099, that's how you know it's a taxable account. When you get a 1099 at the end of every January, at the beginning of February, then you know that it's a taxable account. So what we're trying to help you appreciate is to have a more tax-friendly approach to your investments. And one of the beauties, and the article talks about this, is the superiority of the ETF structure, is that any trading that's done by ETF shareholders that are peers to you, though that buying and selling, and I know that for many years, John Bogle demonized all that trading volume in ETFs. He did that up until his recent passing. But the point is that, and I've even talked to him about this when I interviewed him, the point is that none of that trading volume damages long-term shareholders at all. In fact, if people are buying and selling hundreds and hundreds of millions of shares in an ETF like SPY, which tracks the S&P 500, and I'm a long-term shareholder, just buying and holding, all that transaction, all that trading volume doesn't really impact me in any meaningful way. In fact, actually, I could make an argument that that's good, all that trading volume, because it creates tighter bid-ask spreads. When I go to trade that ETF, buy or sell it, that's going to create a lot less frictional cost to me, the ETF investor. So all that trading volume that has been demonized is actually good for me from a trading perspective. It reduces my cost. I find it ironic that the people that are the biggest complainers of investment cost are the ones that demonize ETF trading volume, which reduces an investor's cost. That's something we should be celebrating, not demonizing. But the point that I'm getting back to from a tax perspective, and this is why the ETF structure is superior to the mutual fund structure. The mutual fund structure, in my view, is an antiquated object. It's outdated. It's a relic from the past. It's been replaced by a much better vehicle from a tax perspective. And we'll look at this later on in the show from other perspectives, but I want to hit on this tax perspective thing. So what you do, or as a shareholder, whether you buy and sell that ETF, it does not impact other ETF shareholders. That's all you need to remember. Okay? That's a beautiful thing. I, as an investor, should not be on the hook, tax-wise, for the activity of other shareholders. Who would buy an investment that impacts their own tax situation when others are buying and selling? That's the stupidest thing in the world. And yet that's what mutual funds do. So when we come back, we're going to talk about other specifics that lend themselves to the superiority of the ETF structure. I'm Ron DeLegge. This is the Index Investing Show. At Index Show is my Twitter handle. I'll be right back.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, coming up a little bit later, I want to get you caught up on Morningstar's latest report of U.S. actively managed mutual funds versus indexes, and some revealing data there that you need to know about, so stay tuned for that, and it will help to reinforce your own investment philosophy, which should be index, the portfolio, the retirement investments, the assets that you're managing, the money that you care about. 844-305-7800 is the number if you'd like to join us. At Index Show is my Twitter handle. And on the Twitter feed, we've got a lot of conversations and things that we've been sharing with you. I shared a tweet this past week about Goldman Sachs scaling back its commodities trading desk. Now, if you're into contrarian indicators, and I sort of am, I think contrarian indicators can be quite useful. But if you're into them, I'd say Goldman Sachs scaling down its commodities trading desk is a pretty darn good contrarian indicator. And as Paul Tudor Jones once said, do the trade that makes you puke. A contrarian who knows what he's talking about, net worth somewhere in the vicinity of $4.5 billion. So I got a tweet from Dylan Grabowski asking about commodities. This is a contrarian asset class. It's been out of favor a long time. He asks, what ETFs would you recommend for someone looking to diversify and expose a little bit of their portfolio to commodities? I'm thinking of 5% of my total portfolio. Thank you for that tweet, Dylan. And here's my answer. You want to choose exchange-traded products that are a proxy for the entire commodities group. That includes funds like ticker symbol USCI, ticker symbol GCC, and you can even include ticker symbol DBC. And I also sent a link to Dylan, which you can see on my Twitter feed, of a broad commodity ETP guide that has all the commodities exchange-traded products and funds on a two-sheet piece, a two-sheet PDF. So I've got a link to that on my Twitter feed at Index Show. And the other thing I want to mention, too, is I cover portfolio construction strategies with commodity ETPs on my online classes. And I encourage you to enroll in that, Dylan, as well as any other listeners. Just go to indexshow.com, and you can see my video breakdown of those specific commodity exchange-traded products. Go to indexshow.com and click on Ron's online classes. The thing I want to say about commodities is that this is the one area that I consistently see missing from most investor portfolios. Now, you cannot claim to have a fully diversified portfolio if you don't have exposure to commodities. Commodities are a major asset class. And I know in this country, not just in this country, but around the globe, there seems to be an anti-commodities investing bias. People seem to think that, all I need is stocks and bonds, and I'm good. I'm set. That's all I need to have a diversified portfolio. Well, that's not accurate because it excludes major asset classes like commodities. And of course, you have other major asset classes besides stocks and bonds. You've got real estate. You've got cash. I mean, those are the biggies. So you can't claim to have a diversified portfolio if you just own stocks and bonds. What you have is a partially diversified portfolio, or what I might refer to as a under-diversified portfolio. So, good question, Dylan. Thank you for that tweet. Also on the Twitter feed, we're going to get into a little bit later a research report from Morningstar, taking a look at the performance of actively managed mutual funds versus passive funds or index funds in their peer categories. So I got some stats that I want to share with you on that. 844-305-7800 is the number. You're listening to the Index Investing Show, and we're here every week at this same hour. If you'd like to reach out, you can follow us or tweet us on Twitter at Index Show. You can also call the program 844-305-7800. So if you're just joining us, we've been talking about the superiority of the ETF structure. And in the first segment, we explained to you how ETFs shelter investors, especially those of you with taxable money, taxable brokerage accounts. You're sheltered from the tyranny of paying unnecessary taxes. And that's not the case when you own mutual funds in a taxable account. This even includes index mutual funds, by the way, which are often touted as tax-friendly vehicles. Well, you compare the tax friendliness of index ETFs versus index mutual fund. I'll take an index ETF any day. And the main reason, again, is that what shareholders do in an ETF does not impact their fellow ETF shareholders. So if they're buying and selling in a massive quantity with large trading volume, that does not impact me as a long-term ETF shareholder one iota. And that's the beauty of the ETF structure. That's a superior structure. Whereas with the mutual fund, what my fellow shareholders are doing can and does impact my tax situation. That's an inferiority type of, or an inferior type of product structure. And that's a problem. That's a problem that I don't think is well explained by the mutual fund industry. It's a flaw. It's a massive flaw of the mutual fund structure when what one shareholder does can impact in a negative way the tax situation of another shareholder. That's something that needs to be explained to the investing public, and it hasn't. But this is why you have shows like this to bring these matters to light and to help you to understand that you need to limit to the max your exposure to these type of flaws. The way that you do it is by owning ETFs. If you own a taxable investment account, you want to look at this. And of course, why pay taxes that are unnecessary from year to year to year to year with these mutual funds that continue to hit you with unnecessary capital gains? Even though you're a long-term buy and hold investor, you haven't sold those funds, but you're still being hit with capital gains. So we're trying to help you understand and appreciate these things so that you can have a more positive experience with your investments and also reduce your cost and reach your financial goals. 844-305-7800 is the number. We're here. If you'd like to talk with us about a specific investment strategy, a specific stock, mutual fund, or ETF, we can do that. Just give us your first name along with your city. Now, also on the Twitter feed, we've got a couple other things that I want to share with you. Managed payout funds, which were touted by the fund industry as being able to help people to have income during retirement. Well, some of these managed payout funds have been having some problems. They've been having problems, and there's another article link. The title is Generating Retirement Income Isn't Easy Even for Vanguard. And it talks about some of the problems that these managed payout funds are facing, namely not being able to generate enough income that retirees can count on. And as I have always said, that retirement income is a crucial aspect of your lifestyle during retirement, and you cannot get this wrong. There's lots of other things in life that you can get wrong. This is not one of them. And so I want to expound on this, I think, in the next segment, just briefly, and tell you some of the problems that these managed payout funds are facing. Also coming up, we're going to take a look at that Morningstar report of active funds versus passive indexes. Surprising results. I'm Rhonda Legge. This is the Index Investing Show. Stay with us.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
With more than 2,000 ETFs in the U.S. market, finding the right funds is more complicated than ever. ETFguide.com simplifies your life by sending you free guides on the top ETFs. Sign up at etfguide.com/snapshot. Choose from our library of free guides covering commodities, inverse, and leverage funds, along with new ETF launches. Our carefully screened ETF guides will save you time. Sign up at etfguide.com/snapshot.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
Continuing the conversation of managed payout funds. So Vanguard Managed Payout Fund, ticker symbol VPGDX, is one of the largest types of funds that really aims to help retirees with income. So what it does is that it aims to pay a consistent percentage. Usually it's an annual target distribution, and the rate that they try to average is 4%. Well, the problem is because of last quarter's sell-off in stocks, Vanguard was forced to cut the payout for this particular fund, the Vanguard Managed Payout Fund. It cut the payout to investors by 8% after the portfolio took a hit. And so the actual payout, as many might not be aware, is determined in January. It's based on the fund average performance for the portfolio over the prior 3 years. So the payout for this year was based on the performance over 2016, 2017, and 2018, which meant it included the fund's 5.7% loss last year. And so thus that translated into an 8% lower payout this year compared to last year. Now that's not something that many retirees want or look forward to, are cuts to their income. And so this is one of the problems with these managed payout funds, is that they've got no downside protection. And when you're looking for a reliable source of income, I hope you're not using managed payout funds, because they're not a reliable source of income, as this shows you. If you're looking for a reliable, guaranteed income source, you should be sticking with something like an annuity, which will guarantee a fixed monthly portion, and in some cases even an increasing payout based upon a certain time frame. But the key here is that these managed payout funds, I'm not saying the concept is necessarily bad, but they're trying to do something that they just can't do. They're not able to deliver a consistent, reliable source of income when you've got markets. They're basically held hostage to markets. These payouts, that's how they work. So they're based on the previous 3 years of market performance, and if you take a hit in any one of those years or multiple years, you're going to see payouts of these managed payout funds fall big time. And perhaps that's one of the reasons why these funds have not really become that popular. But nevertheless, we're trying to alert you to these situations. If you're trying to use a hammer to do the job of a screwdriver, it's not going to work out too well. And that is exactly what's happening with these managed payout funds. They're trying to do something that they really are not built for, delivering a consistent income source for retirees. I mean, it's pretty impossible with the strategy that they propose. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here. Coming up a little bit later, we're going to give you a recap on what's happening with some of the key sector ETFs within the S&P 500. Also, I want to finish today's program talking about the superiority of the ETF structure. We discussed earlier how ETFs benefit you from a tax perspective. Well, there's one more thing on my long list of why ETFs are superior to the mutual fund structure. And I just want to focus on one of those things on that long list that I think is very important, something called daily liquidity. So stay tuned for that. At Index Show is my Twitter handle. By the way, if you missed last week's program, the title of the podcast or show was called Commandments for Trading ETFs. And we have it available as a podcast. You can listen to that at Spotify, iTunes, YouTube, or our website, indexshow.com. We archive every single radio broadcast that we do. In that particular episode, we talked about Commandments for Trading ETFs. We also did an interview with Sylvia Jablonski at Direction Investments. We talked about some of the latest iteration and innovation that's happening in the ETF market, something called relative weighted indexes. So listen to that program. Again, indexshow.com. We archive every single show. We don't really talk too much on the program about estate planning, but I've got a link on our Twitter feed at Index Show to an article that pointed out that nearly half of older Americans, think about this, nearly half of older Americans don't have will estate plans. Can you imagine that? Let me give you an estate planning tip that you need to do it before you're dead. Here's the reason why. Being dead, from what I've heard, is a full-time job. In fact, once you're dead, you're so busy being dead, like I said, it's a full-time job, you have no time to do anything else. And so you're so busy being dead that you don't have time for things like estate planning. So what I'm saying to you is that you do this, you write up a will, you have a trust, you do that while you're still alive and while you're still conscious, while you're still able to make a decision. So that's my estate planning tip for you today. Get that done before you kick the bucket. Now, I want to talk to you about this latest Morningstar research report. It's called the Morning. What is the title of this report? Anyway, I don't know what it is, the title specifically, but we've got the link to the full article, the full report. It's not an article. It's called Morningstar's Active Passive Barometer. That's what it's called. And so here's a couple of key takeaways that I want to share with you. Just 38% of active U.S. stock funds survived and outperformed their average passive peer in 2018. Now that's down from 46% in 2017. Active value funds saw the biggest decline in success, with only 26% of such funds beating the average passive fund in their categories. Now, we were sold the idea that active funds should be able to perform better in declining markets. Well, last year, 2018, the market declined modestly. Stocks were down modestly, about 5 or 6%, most of the broad indexes, and yet just 38% of active stock funds even survived or managed to outperform. So if we do the math on this, let's just reverse this. 100% minus 38, that means more than 50%, more than 60% to be precise, of these active stock funds failed to outperform, failed to beat the indexes. And that's just a snapshot of 1 year. If we look at this on a longer term basis, their numbers really go down. Fewer and fewer even live or survive over the long run, much less manage to outperform the indexes. Also, another key takeaway is that actively managed funds have failed to survive and beat their benchmarks, especially over longer time horizons. According to Morningstar, only 24% of all active funds topped their average passive rival over the 10-year period ending December 2018. So you want to invest in something, in strategies that turn the odds in your favor, right? It's all about odds. And we turn the odds in our favor when we index our portfolios, our retirement money. We index our money to the market. We do that with index ETFs. That is the foundation of your investment portfolio. When I say foundation, I mean your core. In other words, that should be where most of your assets reside. More than 50% of your money. If you want to invest in active funds and active strategies and venture capital and hedge funds and whatever other crazy ideas come to your mind, you could do that with your play money. The money you don't care about, your non-core portfolio, that's the proper context for building a architecturally sound investment portfolio. More when we return. This is the Index Investing Show. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, there's a couple of important investment trends that I want to alert you to. Let's just take a look at this from a industry sector perspective, because if we look at the broader markets, at least equity-wise, pretty good start to 2019. But really, if we take a look at industry sector ETFs, that really tells us where the action is. Right now, the continued leaders are the communication services sector, ticker symbol XLC, ahead by almost 11%. And if you open up your app, the Select Sector Spider app, which is now available at Apple's App Store, we've been talking about this over the past several weeks, you'll see some of the top holdings within XLC are familiar companies like Facebook and Alphabet, Netflix, Walt Disney, AT&T. So XLC is a top performer. These types of stocks are leading the stock market, the S&P 500, higher. Another top performer is XLK, which is the technology sector. Now, some of those companies currently located in XLC once resided in XLK, but they have been shifted. They have been shifted just because there's been changes to the way these indexes are constructed, changes to the way business is being done today. And many of these companies cross over. They're not just technology companies, but they're media companies. They're involved in a lot of different things. But the technology sector focuses on just companies involved in software, IT consulting, semiconductor equipment, computers, that kind of thing. And if you take a look at XLK's top holdings, you've got Microsoft, you've got Visa, you've got Intel, Cisco Systems, Oracle, a lot of software type of companies. And XLK ahead by just over 9.5%. That's another leader. And then XLY is the consumer discretionary sector ETF. That one ahead by just over 8%. Some of the top holdings there, Amazon.com, Home Depot, Nike, and McDonald's. So XLY also a top performer. Now, if we look at this globally, what are the trends globally in the equity market? Well, there's some areas that are really, really doing quite well. And if we just look at this regionally, if we focus on Latin America, Latin American stocks right now are sizzling hot. Ticker symbol LBJ, which is the Direction Daily Latin America Bull 3X ETF, ahead by almost 31% since the start of 2019. So that's a top performer. Brazilian stocks have been really strong performers, not just this year, but really throughout that market sell-off of the fourth quarter. Brazilian stocks on a relative basis were strong performers. They held up quite well. BRZU aims for triple daily bullish exposure to Brazilian stocks. BRZU ahead by almost 40% since the start of the year. That is another top performing ETF. And then ILF is the iShares Latin American ETF with exposure to that area without leverage. So those three ETFs tracking that hot area, regionally speaking, Latin America. Now let's finalize today's conversation by discussing one of the last real benefits of the ETF structure and really describing the superiority of ETFs over mutual funds, and that is something called daily liquidity. So what does that mean? Well, think about it this way. I'd like to explain it in an illustrative term. If we take a look at going, let's just say you're going to go to a store to buy something, okay? And you enter the store at, let's say, 9 o'clock in the morning, and you go to buy whatever it is that you need. Let's just suppose it's a grocery store. You buy your groceries, and then you've got all the goods and things that you need for the week. And the store manager comes to you and says, well, you know what? You're not going to be able to leave the store until we close at the end of the day. So you entered the store at 9 o'clock. The store doesn't close till 9 p.m. You got your shopping done in an hour. It's now 10 o'clock. So you're not going to be able to leave the store until the closing. Now, tell me how you're going to feel about that, being held hostage in the store until it closes. Then you can leave. Well, the same thing happens with your investments. When you're a mutual fund shareholder, you do not have daily liquidity. In other words, when you enter that investment, you're not able to get out until the market closes. And that's a huge disadvantage because of the fact is, you don't have much flexibility, number one. But number two is that you don't know the prices that you're paying on that fund. Because remember, when you buy and sell a mutual fund, you're doing it at the net asset value, also known as the NAV. So you cannot put, for example, a limit order in that says, hey, I want to get at least this amount at an NAV price. You can't determine those prices. You don't know what they're going to be. It just happens to be whatever the mutual fund company tells you, and depending, of course, on how the market performed that day. Whereas the ETF gives you what's called daily liquidity. You can get in and you can get out throughout the market day, and you can also predetermine what prices that you want to get in and out at. And that's another huge advantage. I mean, who wants to buy things of whatever cost, especially with your investments? Who wants to buy and sell things at prices that you don't know, right? Does anybody want to make a major purchase? You want to buy a house or a major appliance or an automobile at a price that you don't know, that you can't predetermine? Well, that's mutual fund investing. You're buying and selling at prices that you don't even know. You can't even control or determine. With an ETF, you can put in limit orders, and you can sell and buy at specific prices that you determine, and you know before that trade is executed. And so daily liquidity is something that I think is another huge advantage of ETFs over the traditional mutual fund structure, and really explains the superiority of ETFs over mutual funds. 844-305-7800. That's the number. You're listening to the Index Investing Show. We're here every week at this same hour. At Index Show is my Twitter handle, and you can follow us and tweet us there. Now, taking a look at the major asset classes, if we just take a look at stocks, bonds, commodities, real estate, so far this year, equities are leading. Total U.S. stock market, ETF, ticker symbol SCHB, that's the Schwab U.S. Broad Market ETF, ahead by almost 9% since the start of the year. Bonds, ticker symbol BND, ahead by just over 1%. Global real estate is really, really a strong performer. REET ahead by just over 12%. USCI, which tracks commodities, ahead by almost 3%. And then international and emerging market stocks performing quite well, up about 6 to 7%. VEA and VWO track those particular areas. And as I indicated earlier, within emerging markets, the real hot area right now in terms of bullish performance is with those Latin American stocks. Stocks from countries like Brazil, Colombia, Mexico, those particular areas performing quite strongly. Those, by the way, are year-to-date figures. That means they're from the start of 2019 through the market close of February 8th. 844-305-7800 is the number. You're listening to the Index Investing Show. If you'd like to get a free portfolio report card where I analyze and grade your investments, your retirement portfolio, if you want to know how you're doing, go to portfolioreportcard.com, and you'll get a one-page report that explains to you how your investments are doing in 5 key areas: cost, risk, diversification, performance, and taxes. So those are the 5 areas that you need to know about. See how you're doing. Do you get an A, B, C, D, or F? Well, hopefully you get an A, but at the very least, you'll be able to find out what your strengths and weaknesses are, and that will help you to make improvements in your own investment strategy and investment portfolio. That does it for another episode of the Index Investing Show. Join us again next week.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producer.